Hey, thanks for joining us, and don't forget to hit the subscribe, the like, and the notification button for more. Okay, everybody, it's Kevin Wadsworth and Patrick Karim, North Star Bad Charts again. And hey, look who we've got for you today. It's Chris Vermeulen at the technicaltraders.com. Hi, Chris. How you doing?
I'm great, guys. Thanks for having me on the show.
Great to see you. And so lots going on with the markets over the last few days. Precious metals have been under pressure and had a little bit of a turnaround on Friday after the Fed announcement, of course. US dollar has been powering on its way towards the moon by the looks of it as well. The general markets and equities are what everybody's trying to guess about at the moment as well. And crypto is, of course, tied into all of that. So yeah, take it away, Chris. What do you think? What do you think's going on? Maybe start with gold.
Sure. Yeah. Let me grab my charts here. And all right. So here we've got the daily chart of gold on our right-hand side. Kind of we're going to zoom back a little bit, get a bit bigger perspective here. On the left-hand side is my momentum kind of trading strategy, which not what anybody wants to hear today, but gold's actually popping, and we actually have like a sell signal starting to form that it's moved too far too fast. But that is a totally different strategy. We'll just focus on the big picture here. And as you and I were just talking before camera, we are coming down to a very critical, or we have come down to a critical support zone that was crystal clear resistance in the past. Then it became support, major double bottom, another spike-based news bottom, and then of course we just had this, and the ECB came out, and now we're starting to see a nice bounce. And none of this is a real surprise. We've been talking to subscribers. We had this big measured move, a downside target right down to this level, down to 1675 or 1674 we were looking for, came right down, and now we're getting this really strong bounce. So, you know, from a long-term investor's point of view, you know, I've been talking with subscribers and followers saying this is a point here where, you know, I'm trying to get more metals. It's crazy the difference between, you know, buying physical metals and the actual spot price. There's such a huge disconnect. Feels like we get so ripped off buying physical, but this is a key opportunity. I think if we go back and look at the big picture of gold, like the quarterly chart, which is kind of one of my favorite views, we're in this, you know, major super cycle to the upside. We've got this, you could argue, a big cup and handle formation, but more or less where we are here, I actually feel is very similar to something kind of right back here, or something just like this over here. So I think we've got a lot of room to go for precious metals. But remember, each bar here is 3 months. So this is a major consolidation. And for all we know, it could take another 4 more bars or longer to actually break out. It really depends, I think, what the excuse me, the US stock market is going to do. If we go into a bear market, I think it's going to continue to keep pressure and keep a lid on precious metals, because whenever we get into a bear market, it usually sucks gold down with it. We saw that in the 2008. We saw gold correct quite sharply. It was the first to rebound. It was one of the best asset plays after it. And we've kind of seen that. We got into a somewhat of a bear market now in equities. Gold has pulled back with the market. And I think we could continue to see gold hold up fairly well. But I think there's still quite a bit of time left before I think we see a big break in a run, which would be my next target would be like $2,700 in terms of gold. And I actually did a talk with Wealth 365. This was 2 years ago, and I had drawn on the chart where I expected gold to peak out and pull back. And I don't have it here, it's on my other computer, but it is pretty amazing that I drew this out using time cycles, and the price action of gold is exactly where I pointed out 2 years ago, in the same price range, flagging sideways, and we still have more time to go before it takes off. So it's amazing what these charts can do. I mean, you guys are chartists, I'm a chartist. To me, charts are everything. We only make money when an asset moves in our favor. So why follow fundamentals, which can lead or lag months or years in most cases, versus just follow price, right? And the nice thing about the technicals is we don't need to try and predict tops and bottoms. We just need to identify a trend, follow the trend. And when the analysis tells us the trend is stopping or reversing, we just get out of the trade. It's very, very logical, very straightforward if you can keep your emotions out of it and not have a bias towards something. So that's kind of the big picture of gold where we are. In fact, there's this chart you guys have probably seen. It's available.
Chris,
yeah.
Can I interrupt you 2 seconds? Just back on that chart, and our viewers might be asking the question, those 3 moving averages, what are the lengths of them?
This one here is, so it's the 50, it's the 20, and it's the 5. I don't really use them on the quarterly. That's my daily chart, moving averages. So don't think quarterly and those are the moving averages. I'm not sure what I'd use on quarterly. I just look at the price action. So there's this chart here. It's kind of a small version, but this is kind of telling us when commodities, the SP 500 is super overvalued, where commodities are, and we're down in this spot right over here. You guys have probably seen this chart where commodities are like the cheapest they've ever been compared to the SP 500. And we saw that back over here, you know, in early 2000. Of course, we all know what happened to gold in early 2000. It put in the bottom and then started this massive super cycle run. Well, I think we've just had a stage 1 correction, a multi-year correction. We started in 2019, I think the start of another major super cycle to the upside. And that's kind of where we are now. I think we could see commodities continue to hold up and do well and keep moving higher, while the stock market actually becomes very weak for potentially several years. I mean, a lot of people are thinking the bear market in equities is almost over, or that you know, it might only last a couple more months. But the reality is, the last 3 bear markets have taken about 36 months to get back to break even. You know, that's a long ways away. We're only a few months into one at this point, and I think it could drag out a lot longer than people think. And commodities could continue to move higher and hold their value while stocks fall. And of course, this ratio chart will then move back up kind of towards the mean price. You know, the rubber band effect. It gets stretched one way, goes the opposite way too far, and oscillates back and forth. So I think there's this great opportunity that we're at right now where commodities are going to be a great play in terms of holding their value compared to equities in general.
Yeah, it's incredible, isn't it, that even after the recent moves in commodities that some people have been very surprised about, you look at that chart and you begin to realize just how early we are in that it's a rotation, really, isn't it, from one sector to another. It's following the movements of sort of money in the money markets, and
I think
these cycles are, you know, big things to watch.
Yeah, I think we're 3-5 years of commodities doing very well and stocks somewhat underperforming, and most people are not prepared for that. Everybody got so spoiled in the COVID crash, where before you probably got your first statement from your broker or your advisor of, you know, where your account is, it had already recovered and rebounded. And so like it was it's like a quick bee sting, right? And people probably are feeling like, you know, this 20% correction this year, everybody's like, oh, it's the worst year ever in 50 years. Well, it is, but it's really not all that bad. I mean, there could be another 25% to the downside here. And it could take something like 2 or 3 years easily to play out. And it might take a longer time to recover. And people aren't prepared for that. And people who are buying and holding, anyone near retirement or in retirement, is just going to you know, pretty much delay. I did a talk about this. Any bear market, the average bear market delays somebody retirement by 3 to 7 years. If you're already in retirement, you have to tighten up on your lifestyle. You have to completely cut your lifestyle back, especially with this inflation. So it's all about finding a strategy, not just precious metals, but other assets that are moving up in value. Like the US dollar has been one of the best plays this year. In terms of where to put your money. And the nice thing is the US dollar fluctuation is really, really low. You can get in, and I mean, if I just pull up the dollar index, which you can trade UUP, which is an ETF for it, and I'm just going to go to the daily chart. This is, you know, like just look at this chart. Just a nice steady series of bull flags and complex corrections, nothing deadly by any means. And it just, right now it's pulling back. And that's why we're seeing, I think, gold start to pop a little bit as well. But it's all about trying to find that consistent growth in the market. Where do you need to rotate your portfolio? And we've been out of stocks almost the entire year. We actually just got back into growth stocks 2 days ago. We've already closed out a position. We've already hit 4 targets on our profits. So, I mean, this market right now is coming back to life, the equities market, but it's just going to be a complacency rally, which if I was to kind of show you where I think we are in this overall stock market, 2020 and 2021, early 21 was this euphoric phase. Everyone sitting at home, had nothing to do, got money from the government. Yeah, everybody just piled in. It was just a euphoric phase of everybody buying options and stocks. And now we're I think we're about to go into this complacency rally. I think we're just starting what could be a multi-month rally in the stock market. I don't think we're going to new highs. And then we're going to roll over and people are going to freak out. And then we're going to actually go into a true bear market, the first major leg down. Right now, the market to me is just topped and we're in this bearish phase, but we haven't broken into a bear market yet. And this will pull, I think, gold, silver down with it. At best case, I think gold and silver will hold their ground, which is ideally what we all want. But again, we just have to follow price to see what it's going to do. So we're in this complacency stage. We're in, hopefully we're going to get a big move here for a couple months, but for all we know, this market's going to roll over next week. And so we're active managing our positions because you can't just buy and hope in this type of market or ever really if you want to manage and protect your capital. So that's kind of where we are in the grand scheme of things. And, if we were to look at the kind of the stages that the stock market is in right now, the stock market is in this stage 3. And if you follow Stan Weinstein, which you guys probably know his work here, stage 3s and stage 1s are areas you generally they're very difficult to trade. There's not a lot of opportunity. It's very stock or sector driven and they're quick moves and then they just fizzle right out, which is what we've been seeing. The opportunity is in a stage 2 bull market or a stage 4 decline when there's a trend. And, hopefully we're going to get a nice rally here and then we're going to have a killer opportunity, I think, to profit from falling markets. And real estate's going to get hit. In my town alone, our real estate is down 23% from the high back in February. And I still think there's another 20% to go. I mean, everything more than doubled in only a couple of years here. And it's just so lofty, everything. So that's kind of where I think we are in the grand scheme of things, kind of the stock market and gold.
Yeah, it's interesting when you look at that stage analysis there. That very much reflects where we have been with gold during that basing process as well. So whilst the markets have been euphoric, you wouldn't have described gold as being euphoric over the last couple of years. So, as I totally agree. Should the markets roll over, it's very likely that everything gets dragged down with them initially, at least. But gold having not seen that euphoric stage over the last couple of years, will and I'm not entirely sure what your view going forward. Well, I presume your view going forwards is similar to ours, that gold will do extremely well in the longer run, whilst the markets may very well not do so.
For sure, yeah. I think gold is kind of struggling, and it's gonna chop around until the stock market puts in a bottom. When is that? A couple of weeks from now or a couple of years, who knows? But eventually, when market and all the fear works through investors and we start to come out the other end, that's when I think gold is just going to go, is going to rocket higher. And depending how this whole platform plays out, I mean, we could see gold, blast past 26, 27, go right to like 35, 3,600. And it all depends on what's going to happen with currencies and countries moving to digital currencies. And there's talks about a gold-backed currency. I mean, there's so many things up in the air. But the nice thing is the charts typically will lead us in the right direction. And so that's the nice thing. We just have to follow price, and the price has already got all the stuff that we don't know pretty much factored in most cases.
I'm so happy to hear you say that, because that's why I keep telling people, either you think you're God and you're better than 10,000 analysts, which recommend stuff to their hedge fund CEOs that they manage trillions of money. Either you think you're smarter than all of them, or you just wait and look at the chart, and when they place their chips, you'll see it in the charts, right? It's that's why charting is so appealing.
Yeah, I mean, I remember when I started trading in 1997, I did really well, and then the 2001 bear market started, and of course I was buying these tech stocks that had good earnings. They were growing. They actually were doing well, yet the price still got cut in half and beyond that, right? And I lost a fortune buying stocks that had unbelievable earnings. Back then I was trading more options and covered calls because I was totally new, learning, which I would never trade covered calls in a bear market anymore. But that was my wake up point. It was like, why am I following fundamentals? It was so fundamentally driven back then. Everybody was like, got to find value stocks, undervalued, blah, blah, blah. And of course, they all just fall in value. So when it's undervalued, it's still going to fall another 20, 50%, right? And you only have to get burned a couple of times buying solid companies growing and they continue to fall. And you're like, screw that. Fundamentals is garbage in terms of, being an active investor and following price. I only exclusively hold assets going up. If they're trading sideways or down, we're out. We're sitting in cash. And that's been one of our best plays this year is sitting in cash. This market's collapsed. We've had a couple trades where we get in, make some gains, get out. The market rolls over. Our system says get out. We lock in gains. I mean, we're sidestepping this whole market just because of simple technical analysis and managing our positions and risk, right? Locking in gains, moving up stops, not being greedy, knowing the longer term trend is down here. So any rally is going to be short lived.
Yeah, I totally agree. Fundamentals are interesting, and it's good to have a backstory. But a really good example that I always give on that is the uranium market after the Fukushima disaster in Japan. Yeah. A few years after that, there were some very, very good fundamental arguments for uranium stocks doing well, and some very, very good fundamental cases for investing in uranium. But the case was great, but it went years and years and years of huge losses. And of course, we know the uranium stocks lost 90+% of their of their value. So it wasn't until the market broke out and you saw some a good clear technical breakout. You got the chart there for global X uranium, and you put that I don't know, it might look is that on the log chart or is that on the linear chart there? That's I think if you put it on the log, it might possibly pop it up a little bit more clearly. So you can put the breakout line on there very clearly. You can see that sort of around about 2021, very, very clear breakout there. And until you get that breakout and that confirmation and the prices move back above key moving averages, it's just a fundamental story. The fundamentals are great, but look how many years, even if you'd bought in 2016, when it more or less bottomed, you'd have had to have watched your money grind sideways and then another large sell-off in 2020 there before the real breakout occurred. So fundamentals are great to listen to, and it makes a great story, but end of the day, until it's confirmed on the chart, you're just wasting your time and your money.
Totally agree. I obviously fundamentals can play a really good role when you're in a bull market, a brand new stage 2, everything's fresh, everybody's real money's starting to pile in, just like we saw just after the COVID crash. I mean, everybody piled into growth stocks. And I mean, there's ways that you can take advantage of it without really having to do all the work of fundamentals, because it's a ton of work. And the best way would be to move into an ETF that buys, good value growth stocks. So they do all the research for you, because if the market's going up and trending higher, everything pretty much goes higher. There's almost everything has a positive correlation with the stock markets over the long run in most things. So you could get into an ETF that focuses on stocks with, huge opportunity. Could be an ARK ETF. They do the research for it, but obviously so many people got burned by ARK. It's amazing. It was the best thing ever since sliced bread. And now that it's down like 75% or was 70%, everyone absolutely hates it and says it's the worst thing ever. But to me, I mean, it's a huge opportunity. They do all the work. They're finding good companies, and it's, when we get into a new buy signal like we are, in fact, we're actually in the ARK ETF. We've already hit a target. It's already screaming to the upside. It's a great opportunity. I think it's one of the best plays going forward if growth stocks are going to continue to have an upward bias. And it's funny because everybody just got burned and nobody wants to touch it. So whenever I bring it up, everybody's got a sour taste in their mouth that I'm not touching that. I hate Kathy Wood. I hate ARK ETFs, but I mean, that's obviously a good sign that it's probably a good point for growth stocks if nobody wants them and everybody's scared of them, right?
Yeah, exactly. And being contrarian like that is very, very difficult. I've spoken to Pat about it on many occasions, and buying weakness and selling into strength is a very difficult thing to do. It goes against all of your emotions. When there's euphoria in the air, the last thing you feel like you should be doing is selling. And when there's, you know, blood in the streets, if you want to put it that way, then it's, you know, it feels wrong to be buying. But that's exactly what you need to do, you know. And that was the case with uranium stocks when they'd put in their final capitulation lows. And, you know, same with any market, you know, whether it's gold, silver, or whatever. You get those capitulation lows. 2008 was a good example. You know, it's it's tough. It's tough to do, but the charts really do help with that. So you've got the silver futures chart on there as well. What are your thoughts on that?
Yeah, silver, to me, silver is a really ugly chart. It's all over the place. It likes to break and pierce through resistance and support levels. It's not nearly as clean, I find, as gold and gold miners. But I mean, it's looking like it's oversold, just like gold. I think we're primed and ready to see one of these rallies here. The big question is, you know, is it just going to be a bounce before going lower, or is it going to build a platform and start to build up on the right-hand side? I mean, silver's such a gnarly chart. From a technical standpoint, you know, some assets I just don't like to chart. Like this stuff's really noisy. I'm pretty picky. I mean, I don't go out looking to be a hero. If I don't like a chart, I'm like, I'm not even going to try. But silver, you know, is short-term wise, it's oversold. It's right down at a really critical support level. Obviously, we come right down here. It's flirting with all of these highs. Then we had the breakout, and now we're back down to this post-COVID kind of breakout level. So gold, silver, same thing. They're at major support. They look like they're putting in a reversal. I think they're ready for a week or two bounce. And we just need to see if there's going to be any legs beyond that, or if it's going to continue to struggle. I think there's a good opportunity if we go into this complacency rally with the stock market, where we see a 1, 2, or 3 month rally. I actually think gold miners could become one of the leading sectors. We've seen this happen time and time again in the past, that the gold miners start to perform really, really well. And they'll actually hold up while the stock market actually starts to roll over again. And we saw that just before the COVID crash. We actually had a great trade in GDXJ, made really big returns. Stock market started to roll over or weaken. We got out of the play, and we saw this back in 2007, 2008. I think we could see that again. And if we see the gold miners actually start to rally really strong here in the next couple of months and become a leader, that to me is actually more of a red flag that we're going to have a great big market collapse, the leg down in the bear market that I was pointing to before. While it'll be good for short-term trading in gold and silver, longer term, it's telling me there's going to be a lot more blood in the streets, and really it hasn't begun yet. So that's kind of the take, and silver will follow suit. All these things kind of move together. They're pretty much the same asset. Just give or take a little more fluctuation percentage-wise, depending on if it's stocks or silver or gold.
It's always a little bit unnerving when the gold-silver ratio continues to climb at times like this. We've seen gold moving reasonably strongly today and yesterday, but silver not moving anywhere near as strongly. So the gold-silver ratio is still rising. And until that shows some signs of downward, you know, some convincing downward movement, it's actually in a rising wedge pattern at the moment, the gold-silver ratio. So until that kind of breaks down, the longer-term picture for the metals is debatable, to say the least.
And the crazy part is, you know, you look back in time when gold, you know, back in 2010, 2011, where gold miners are. I mean, it's crazy to think that these things just continue to like totally lag. Like we should be back up at these highs is just logic in my head. Like, you know, gold's back up at the same price as it was over here. Why aren't miners, you know, up here screaming higher and leading the way, that they're actually, you know, pointing to gold going higher in the long run? And miners should be breaking out or trading up here, but they just refuse to get traction. And they're at a major pivot point, oversold here. And maybe this means, you know, we're still, you know, look at this chart. Look at those vertical bars. Each one of those is a year, right? Maybe we're still a year or 2 or 3 away from the massive breakout in miners and gold. And we're not going to know, and I'm not holding my breath for it. I mean, they're not favorable. We're not trading them at this point. So until they, you know, become a good asset, one of the best assets, we're not going to touch it other than long-term investing, I do continue to stockpile physical metals, but that's not a trade. That's kind of like an insurance / hedge. It's a small portion of what I do. And also just because I love holding physical metal. There's something about it.
There is something about it, you're right. But I mean, the ratio of gold to miners is an interesting chart as well, and that does give some clues as to, you know, when the miners may start to gain some ground. But I guess gold is acting as a barometer. It's measuring loss of purchasing power, and therefore it's holding relatively firm in terms of comparison to the miners, which are affected by input costs, labor costs, increased energy costs, all that kind of stuff. So the cost of getting the stuff out of the ground is rising significantly. Once it's out of the ground, its value is relatively steady, because gold just does what gold does. It sits there and tells you how much you're losing your purchasing power over prolonged periods of time, I should say. Of course, over the last year or two, it hasn't really begun to truly reflect that just yet. But it's it is interesting when you compare a lot of this stuff to inflation. You can plot the US dollar against inflation, DXY against inflation, and it's that does start to put a different perspective on things. But interesting times. Yeah, things are delicately balanced, I think, Chris, to say the least.
For sure.
What else have you got that you want to show us before we wrap up today? Any other thoughts on markets in general? What do you think about cryptos, for example? Do you think they're going to follow general markets, or shall we save cryptos for another day? Of course, Bitcoin hit 20,000, didn't it?
Yeah, I don't have the. Let me see if I can pull it up here.
Well, Kevin, technical analysis guys must be so tired of always being asked your opinion on Bitcoin. One day it's like, aren't you tired, Chris, of people asking you, where's Bitcoin going? Like, who cares?
Is it going down? No? Is it going up? Are we going to 10,000? Is it going to 30,000?
Yeah, it's not something that I specialize in or really care that much about. It's not my thing. My whole focus is I like to trade large amounts of money with more stable assets. I like the indexes. I like bonds. I like the US dollar index ETFs. I like to be able to move, fewer trades, fewer positions, and ride tides, right? I don't like to get into stuff that's going to be 15, 20% moves because some other platform just got hacked or because Elon says something. So this type of trading, this is like trading and somewhat gambling, and it's just not my thing. I think Bitcoin here I talked about it in detail. I still cover it. It's just, it's not a huge passion of mine by any means. I think Bitcoin could push up to about 26,000, 2,500 or 25,500. I think it's still clearly in a pretty major downtrend when we look at it. Yeah, I think we're going down to 16,000 and potentially down to about 11,000. I mean, this is a huge measured move to the downside. Actually overshot it because a lot of people are starting to panic out of it. Because the reality is, when you look at the Bitcoin, all the businesses started with Bitcoin were in like this phase here. Everybody kind of built platforms, got involved here, and now they're all underwater. And so it's created a little bit of an extra sell-off based on a measured move from this bear flag. So it's definitely, people are in no man's land. Most people are losing money. Most businesses are struggling around Bitcoin. But when you look at the chart price action, I mean, it's crystal clear that we are just a series of bear flags, right? It's a series of bear flags within a big bear flag. And really all it is pauses and then drops. And this is at this point still nothing more. It's a little more volatile, but I still think it could come down and maybe build a base here at but I mean, it's still pointing to lower prices. So that's kind of my take on Bitcoin. We're in no man's land and most people are losing money. And typically this is a major topping phase. I think we'll be coming back down into the kind of, this range down in here.
Sorry to interrupt. Can you flip the chart? Can you do that on your scale? Just a trick I have for biased people. You do invert scale. Would you buy, like, this looks like a buy, right? You buy the pullback, right? It's like if I see a chart like beautiful. That, I'm going wrong.
I know it's beautiful. It's a double bottom. It's a W formation, which is super powerful. It's got, you know, a major breakout here. It has just started in a new bull market. This is the first pause and pullback, right? So
and then you realize the chart's upside down.
Well, that's the best trick ever. Like, just like somebody's in love with Bitcoin. Bitcoin. I hear Michael Saylor laser eyes. Okay, flip the chart. Show him that.
Yeah.
If you go, if the guy says I'm going long, then he's got his answer, because that chart looks super bullish.
There's no reason I'd be shorting this. Like, it just put in a massive 1.5 base, and it's breaking out with explosive rallies and nice controlled pauses. Like, it doesn't get a whole lot better than this, right? So yeah, it's a good point. And people, yeah, this takes the bias out of it. It totally makes you see assets from a whole new spectrum, right? Same with bonds, same type of thing. It's like, holy cow. So,
and when you realize the Nasdaq and Bitcoin have been moving more or less in sync, it's a little bit of a sobering thought. It makes you stand back and take a look at the bigger picture and just think, right, where are we headed with this?
Yeah.
I have one curveball though for you, Chris. What's going to make you change your mind to think that, like, no, I was wrong? Do you have a line in the sand somewhere? You say, okay, look, I have to flip the script. I'm going to go long.
Which asset?
Well, okay, let's say silver. What's your line in the sand for silver? For say, okay, silver for me, it's a long trade. It's back in a stage 2, because that's the numbers. Like, a lot of people, they want to know at what price do I get back in this thing?
Right. It really depends on the time frame. Are these people getting in for like a quick swing trade gain, or they are like a long-term investor?
For me, for long-term investment, when do we know the bottom is really in and we're going to go up for the next 2-3 years, like something, a position trade?
Yeah, so I would say right now it's still picking a bottom. This is just a crapshoot. I mean, this looks like a pretty sweet spot for a bounce. Is it going to be the bottom? I don't know. Ideally, I would be looking for price. There's going to be a few levels on here. One will be somewhere right through this area. Obviously, a lot of support became resistance. I naturally want to see a higher high and a higher low, and an impulse wave. Like, so what I want to see is if silver was to rally up here and then pull back and then eventually rally up over here, what I like to see are a break of 2 highs. So if there's a high here, once it breaks it, this would be one, and it needs to break a previous high as well. And that to me is an impulse move, that there's enough momentum here that it has cleared a short-term resistance and then a longer-term resistance. Any pause or pullback from that point forward should be an opportunity to get in and start to catch the next run. And then, you know, it should be kind of rinse and repeat. There'll be a lot of noise and chatter up in this nosebleed section, but if it can break that, it'll be off to the races. So, you know, somewhere above 22, probably 60 or so, because it'll most likely have some pause or pullback along the way and create this kind of internal high, but then it's got to break this external high, and any pause or pullback there, or even the breakout of that, could be bought depending how price consolidates. If price consolidates right under that and builds a nice bull flag, then as soon as it starts to break this bull flag, you could try getting a little early and catch that move. If it kind of creates that, you know, kind of cup and handle formation.
Yeah, that looks great. I totally agree. Let the price start. It's like Stan Weinstein wrote that in his book. The price let the price action go up 50-60% to prove to you that, yes, there is a new trend in place. Because you're right, people could buy here. Let's say it is the low here, but it could stay the low for 6 months at this level. Your opportunity cost, you know, you got to,
for sure.
Like, yeah, this could be the low, but if it stays 6 months there, like, okay, like, that's not good.
Like, if we're playing do you ever see David Lynn play the stock market game where he clicks the button and it moves a bar every time?
Oh, I love that. I didn't see him play that though, but I know that game.
Yeah, I played it with him, and I ended up finding it afterwards. I've played it again, and it's awesome because you just play off gut, and you just click it, and you buy and you sell and you buy and sell. You can't sell partial. You have to be like all in or all out, which makes it a little difficult. But my point is, right now, if I was just clicking, you know, bar for bar, knowing that silver's at this major support level, right when it comes down and hits this level, I'd be hitting like the buy button, not for a long-term buy, but I'd be looking for a knee-jerk reaction, technical bounce. And I'd be looking for like one or two, couple green bars. I'd sell some of it, let it do its thing. You kind of keep letting it mature and sell some more. You can't do that with the game, but it is a lot of fun because you can play these, bounces off key moving averages like the 20-day, 30-day, 50-day, when price, has had a strong rally way above those levels. And the first time they come down and tag those moving averages, if you buy it right at them, they typically have a 1 or 3 day bounce off it. And it makes for these amazing trades. And silver's that same type of thing. If I had that game up right here, I'd hit buy and I'd expect a bounce of the 20-day, potentially the 50-day, and be out and done, right? So that would be like an impulse trade. Here's like just a gut shot, bottom kind of picking play, which I generally don't do. But when you're playing the game, you can do these, and these do work out very well when the technicals line up this well, like they do on gold and silver, which is what we're starting to see now.
Awesome. Sounds like a good idea for our next podcast, Pat. We'll play the stock market game, see who wins.
It's good. It's ruthless. You have to be happy with gains and focus on candlestick pattern. It depends on the time frame. I think when I played it with David, I didn't understand we were day trading. If I knew we were on the day trading, because when you're day trading, there's certain moves from like 9:30 to 10 o'clock. There's a move. 10 o'clock, there's usually a pause. You get a rally to 11. Usually get 11 pause. The day fizzles out at 11:30, 12 o'clock. And I didn't realize we were day trading. I just saw bars. I thought they were daily bars, which daily chart's my favorite. So it would have been awesome if I grasped it, because the chart was a perfect move for a day trade. I just didn't realize it was lunchtime. I thought it was just a day, right? But
well, for anyone that's watching this, if you've got TradingView, of course, you can press the play button on TradingView. So you just scroll back a few years on the S&P, to a time period that I'm not very familiar with, and just hit the play button on TradingView. It's really good for that kind of thing. So yeah, it's good.
That's cool.
It's good fun. Yeah, we'll definitely give that a go. Hey, listen, Chris, it's been absolutely awesome having you on the show today. Really appreciate your thoughts and your insights, and sparing your time to talk to myself and Pat and share everything that you've shared with us today. It's very much appreciated.
Yeah, well, it's always fun talking to fellow chartists who see the light at the end of the tunnel.
Man, I want to keep it short, but I know it's practically impossible to keep it short, man. So it's been a while. I haven't talked to you, and I really appreciate your time, Chris. You've been there like forever before like we started. You were there, so you're a legend, man. So happy to have you.
Yeah, totally agree. Do you want to tell everybody where they can find you, Chris, before we sign off?
Sure. Yeah, they can follow my work at thetechnicaltraders.com. And there we're like tactical traders. So we're constantly rotating between the best sectors or index or currency, whatever is moving up at the time we hold. If it's not moving up, we're in cash. And we kind of avoid volatility, which is the opposite of most people. Usually people get excited when there's huge movement, and we're like, no. If you step back, you won't get slaughtered. So we take a very conservative approach, but it creates a nice, consistent equity curve. That's our goal: is steady growth, no crazy stock trades.
Awesome,
great stuff. You heard it here. Go check it out, everybody. Thank you very much, Chris, for joining us today. Appreciate it.
Thanks, guys.
Thanks, Chris. Take care, man.
Yep. See you later.
Till next time. Remember, subscribe, like, and hit notifications for more.